Hello and welcome back to Chapter 1 Notes. And so we're going to pick up on this lecture video where we left off last time by finishing our short discussion of, our discussion of variable and fixed costs, and then continue on with direct and indirect costs, which I just briefly touched on in the last video. So I just want to make one more comment about variable costs and fixed costs, in that variable costs a cost could be variable with respect to one activity and fixed with respect to another, or variable with respect to one cost object, if you want to think of it that way, and fixed with respect to another cost object. So, for example, if we have annual registration and licenses costs for a fleet of cars that are owned by a fleet of cars owned by a car rental company, or for even any other company, registration and license fees would be a variable cost with respect to the number of cars that are owned, but registration and license fees for a car would be fixed with respect to the number of miles driven by that one car. So it's fixed in one context, variable in another context. And so that's the point, is that some costs, they're not always variable, they're not always fixed. You just have to say with respect to what. What are we talking about? And then the same logic applies to direct versus indirect cost. So when we talk about a direct cost, I'll go on to the next page over here. We say a direct cost, what we're talking about is a cost that is easily traced to a product, department, or activity. So it's easily traced to the cost object. The cost object is the product, department, or activity that receives the cost. An indirect cost, on the other hand, cannot be easily traced to a product, department, or activity. Cannot be easily traced to a product, department, or activity. That is, it can't be easily traced to the cost object. So if we look back over here, and we look at this example of the direct versus the indirect cost on page 4 of your notes, you can see we have a direct cost for insurance on the bottling plant. It's directly traced to the bottling plant, but it's very difficult to directly trace the insurance costs on the plant, at the plant level, to each product that we make. It's kind of like saying, what if you live in an apartment with other roommates, and you have 3 roommates in the apartment? Well, you have utilities costs on the apartment. Utilities costs for the apartment is directly traced to the apartment, but it's very difficult to directly trace each utilities cost to each roommate. So what do? You just kind of typically split it evenly, rather than saying, oh, you use the light for this much time, you use the computer, use the TV for this much time, and then trying to directly trace it like that. It's very difficult to do that, and so what we do is we assume that's an indirect cost. Okay? That would be an example of an indirect cost. We look back over here and we talk about sunk costs versus opportunity costs. I'm just going to talk about these rather than write them down. A sunk cost is a cost that occurred in the past, and it should not influence any future decisions. So for an example, I always ask the class, how many people have been to a movie? 5 minutes into the movie, you know it's bad, and I ask, how many people stay in the movie? A lot of people raise their hand and they say, well, I stay in the movie. And I ask, well, why'd you stay in the movie? Well, I stay in the movie because I paid for the ticket. That's a sunk cost. You're paying for the ticket. The ticket cost, the ticket price that you paid, that's a sunk cost. Because if you leave the movie, you can't get the ticket price back. If you stay in the movie, you still can't get the ticket. You can't get a refund. So what do you care? Because it's the same cost in either situation. Stay in the movie, leave in the movie. You still paid for the ticket, so therefore it should not influence your decision to leave or stay in the movie. Opportunity costs, on the other hand, are benefits foregone by choosing one opportunity or one alternative or over another alternative. So you're suffering an opportunity cost right now by listening to this video rather than watching one of your favorite shows on Netflix, for example. Okay? Although I think this is far more interesting. We also have controllable costs versus non-controllable costs, and again, I'm just going to kind of talk about these rather than write them down. With reference to controllable costs versus non-controllable costs, the idea is that we want to hold managers accountable for costs that would be considered in their control. If it's outside their control and you hold them accountable, It's not really fair. This is somewhat of a subjective call. Right? You could make the case that maybe it really was controllable, or that you had a hurricane come through, or as they like to say in South Carolina, a hurricane comes through and it destroys part of the building, and you incur costs to fix it. You can't control the hurricane, but you could control the fact that you had inadequate or adequate insurance to recover some of those costs. So it's a gray area, okay? Let's talk about some of these review questions very quickly here. Which of the following is most likely to be a variable cost? Depreciation is fixed, rent is fixed, advertising is fixed, cost of materials is variable. Okay? We look over here. Which of the following is most likely to be considered a fixed cost? That's number 2. That's what I'm looking at. This is cost of materials is direct materials, which would be variable. Assembly labor costs, they're paid per hour, so this is also variable. Commissions would be variable. This is direct materials. This is direct labor. This is a variable period cost, which is something we'll talk about more in Chapter 2. Rent is the fixed cost. And costs incurred in the past, those are sunk costs. Okay? 2 key ideas in management accounting. First of all, it's that, let me just catch up here. Decisions rely upon incremental analysis. Okay? So what that means is that if we have 2 costs that differ between alternatives, then we want to consider that cost. And if we have a cost that we incur in alternative A and alternative B, it's not an incremental cost. That's the same thing with the ticket. You paid for the ticket for the movie, and you know it's a bad movie, and you think about going, and then you say, well, I'm not going to go because I paid for the ticket. The problem is that ticket cost is not incremental, because if you stay in the movie or you leave the movie, you still paid for the ticket. So it's not an incremental analysis. It's not an incremental cost, and so that's why we wouldn't consider it. Same thing if we have some benefits that would be in each alternative, alternative A, alternative B, and it's the same benefit, then it just doesn't really matter. Okay? So you look at the second key idea is that this is something your textbook talks about quite a bit. You get what you measure. Okay? So however you start to measure performance, that becomes a de facto incentive for people. Okay? And I'm sure you've seen that in your own work experience. If you measure people on profit, if you have a division manager and you're going to say to that division manager, if you hit a certain profit number, you'll get your bonus, well, they're going to try to do everything that they can, hopefully within ethical bounds, to get that profit number so that they can get their bonus. And so they could do some things that maybe are not good for the organization overall, but could be good for them personally. Okay? So you get what you measure. All right? So then we do have some, and we'll talk more about this as we go throughout the semester, okay? And also some of the course discussion questions. When we look at some example measures over here, if we looked at customer satisfaction at an automobile repair shop, that's one of the performance measures. If that's how we measure a manager, what are some of the things that maybe a potential manager might do? They could give customers a loaner car. Well, that would improve customer satisfaction. We could say, if we're starting to measure some managers by looking at the sales to new customers of an office supply company, what might that manager do? Might have more sales calls on potential versus current customers. Well, we're evaluating them on new customers, so they're going to try to get new customers. Okay? So I kind of already talked about incremental analysis, incremental revenue, and incremental cost, but I'll kind of define those right over here with our incremental analysis. This involves looking at the difference in incremental cost and incremental revenue. Okay? And when I have to define those two terms, incremental revenue is the difference in revenues, or you can even think it more broadly as benefits, between 2 alternatives. Incremental cost, on the other hand, is the difference in cost between 2 alternatives. So what we would do with our decisions, right? With incremental analysis, we would say, okay, what are the benefits that differ between alternative A and alternative B? What are the costs that differ between alternative A and alternative B? Or we can think of it in terms of revenues too. Sometimes I just like to think of it more broadly as benefits. Either which way is fine. And then what we'll do is we'll say, do the incremental revenues exceed the incremental costs? If they do, that's something we should do. If they don't, that's not something that we should do. So let's look at this example problem right over here that considers incremental analysis, okay? Henderson Company, which is one of my many companies, just kidding, manufactures camera lenses. Its lenses are sold through camera shops with a variety of mounting adapters to fit most popular 35mm digital cameras. Recently, our camera company has asked Premiere to produce 20,000 lenses for their compact 35mm digital camera. The lens is identical to Model A that Premiere currently sells for $85. In the past year, Premiere sold 280,000 units of Model A. However, the company has been operating at only 75% practical capacity and can easily accommodate the production of an additional 20,000 units. How do we calculate? And then what we have is the standard cost of producing one model of A. We have our direct materials right over here. We have our direct labor, we have a variable overhead, and we have our fixed overhead. Blix is offered to buy the 20,000 lenses from Premiere, for $73, but you can see here's our standard cost is $75. Should we do this? Well, if you just look at the surface, you say, no way, cost is higher than revenue, we're going to lose money. But are there some costs that are not incremental? Are there some costs that we will incur regardless of whether or not we take this special order? And yes, this, right? So if you came over here, if you went over to the prior page, and it says this is based upon 280,000 units, right? So what I could do is I could go 280,000 times $20, which gives me $5,600,000 in fixed costs, fixed overhead. So fixed overhead would be like rent on the factory. So what we're saying is, whether or not we take this special order, we're still going to have to pay rent on the factory of $5.6 million. So this does not matter, because we are going to have to pay it regardless of whether we take this order for 20,000 lenses or we don't take the order. So when we say, first, are there any irrelevant costs? Yes, we say fixed manufacturing overhead. So now what we can do is now we can complete our analysis, and what we can say is, what are our incremental revenues? 20,000 lenses times the 73, which gives us $1,460,000. What are our incremental costs? So I can come over here and I'll just do it. I'll save direct labor and I'll save my variable overhead. Okay. Direct materials, 20,000 times the 30 gives us our 600,000. 20,000 times the 15 is going to give us half at 300,000. And then what we have is our variable overhead, 20,000 times the 10 gives us 200,000. Our incremental costs, so what I'm saying over here is that if we make these lenses, we are going to have more materials, more labor, and more variable overhead, because we have to make the lenses. And so these are our additional costs to make the 20,000 lenses. So those are incremental costs. So when we add these up, right, we get 1,100,000. Our incremental revenue exceeds our incremental cost. By $360,000. The $360,000 is our incremental profit. And so yes, we should take the order because our incremental revenues exceed our incremental costs. And yes, we should take the order because we do have an incremental profit. Okay? So what I want you to do now is I want you to give problem 1-2 a try, and then the next lecture video that I have will resume on me covering problem 1-2. Okay, thank you.